Hey, Saretsky here. Welcome back to the show. Lots to touch on this week. We got some updates from the Federal Reserve. We got some commentary from Tiff Macklem with the Bank of Canada. We got some huge movement in the bond market and reflecting into mortgage rates. We got some update on national housing prices. So there's really a lot to get through in this week's video. So I'm going to kind of walk you guys through that. But again, we have to frame it up this week with the big headline, which was Jay Powell, the head of the Federal Reserve, the world's largest and most important central bank, coming out with a very dovish speech, basically an update from the Fed, saying that they're now expecting, as per their own dot plot projections, which is, they survey all of their voting members at the Fed to say, okay, where do we think interest rates are going to be? And so their dot plots are calling for three rate cuts in 2024. Again, whether that actually comes to fruition or not is anyone's guess. Could be more, could be less. But the fact of the matter that they came out and said, hey, we're starting to kind of have that conversation. This is where our voting members see interest rates by the end of the year. Again, 3 rate cuts. The markets, I think, are maybe getting a little bit over excited and ahead of themselves, are pricing in six cuts. So that's the market's expectation. Now, again, where we're going to fall remains to be seen, but I think it kind of just throws an interesting wrench in the whole conversation here moving forward. And so what this basically did is, for the Bank of Canada, right, if you're Tiff Macklem, we all know that the Canadian economy is much more sensitive to interest rates, right? You think about the U.S., you've got 30-year fixed rate mortgages. Everybody refied during the pandemic at rock bottom levels, locked in their mortgage rate for 30 years. Canada, you got a third of the float is on variable rate mortgages. Their longest fix is a 5-year term, so it's a market that's much more susceptible to interest rates. So Tiff Macklem, despite what he might want to tell the general public, is secretly hoping for a softer Fed, because the Bank of Canada is going to have to cut before the Fed in reality. If you look at just this week, we had Canada's household debt service ratio numbers came out. They just hit a new all-time high. You put this in comparison, into contrast with the United States, and it's not even close, right? The U.S. went through that deleveraging cycle. Their households went through that deleveraging cycle during the 2008-2009 financial crisis. Canadian households just kind of kept adding and piling onto the debt load. So, again, the sensitivity to interest rates in Canada is far, far superior than in the U.S. So Tiff Macklem, right? But he can't just start aggressively cutting interest rates if other central banks aren't cutting rates, particularly the Fed, because then you're basically sacrificing the Canadian dollar and then potentially even importing even more inflation. So he needs some help from the Fed. So Tiff Macklem, while he might not be publicly saying it, I'm sure he is breathing a sigh of relief. But we did actually get some comments from Tiff Macklem this week. So let's clip to those right now.
Looking ahead, I expect 2024 to be a year of transition. The effects of past interest rate increases will continue to work through the economy, restraining spending and limiting growth and employment. Unfortunately, this is what's needed to take the remaining steam out of inflation. But this period of weakness will pave the way to a more balanced economy. We expect growth and jobs to be picking up later next year, and inflation will be getting close to the 2% target. And once Governing Council is assured that we are clearly on a path back to price stability, we will be considering whether and when we can lower our policy interest rate. I know it's tempting to rush ahead to that discussion, but it's still too early to consider cutting our policy rate. Until we see evidence that we are clearly on a path back to 2% inflation, I expect Governing Council will continue to debate whether monetary policy is restrictive enough and how long it needs to remain restrictive to restore price stability.
So again, Tiff's saying, hey, you know what, guys, these jawbony markets, it's not time to be thinking about rate cuts. We still got to act tough. And again, this is part of the imaging of central banks, right? They have to get their messaging out to get markets to do what they want, right? So, you go back and think during the pandemic, which was when the economy was shutting down, everybody's panicking, we're worried about potentially going into a depression. He says, don't worry, guys, rates are going to stay low for a very, very long time. Hammers rates down to zero, gives that forward guidance to encouraging people to borrow. Vice versa, is he can't it's a little bit early to be saying, hey guys, okay, we're going to start cutting rates here. He still has to act tough. But I think deep down, we know that the Bank of Canada is done. It's really just a matter of when they're going to start cutting, whether that's in Q1 or Q2 or Q3 of next year. We know that that's kind of the next move. So he's still sort of jawboning markets. And part of that is ultimately because, we've seen as markets get ahead of themselves and start expecting rate cuts, bond yields have collapsed. And this basically is an easing of financial conditions, right? As fixed, as bond yields come down, the cost of borrowing money gets cheaper. It is an easing of financial conditions. And so, if you're still worried a little bit about the inflation fight, it's probably not necessarily what you want to see. So, for example, I look at the Canada 5-year bond, right? Just the thing that we watch most closely that prices your fixed rate mortgages here in Canada. That Canada 5-year bond yield is down 120 basis points in the last 2 months. I mean, these are massive moves for, government debt. I mean, it's just, you're not supposed to have that kind of volatility in the bond market. So we've seen 120 basis point move. You've got your Canada 5-year today at about 3.2%. If you go back to earlier this year in, March, April, the spring market, and everyone's like, hey, it was pretty busy during the spring market. It's because we had the Canada 5-year was at about 3%, 2.9, 3%. And so you had 3-year fixed mortgages around 4.7. And that was sort of enough to get people off the sidelines and transacting. And so right now, you've still got, despite your Canada 5-year only being like 20 basis points higher, 25 basis points higher, is your 3-year today is, the best probably you're going to get is about 5.7. Maybe if you really squeeze some arms, you're 5.6. So banks are still pricing in a pretty huge spread. But those in the mortgage industry that I chat with and follow along with, there's an expectation that banks are going to pass at least more of that through in the coming months, particularly as you get into the spring market. During the spring housing market, it's when banks tend to be more aggressive, more competitive for mortgages and for new business. And so you'll see that. So basically, assuming yields hold here, I suspect we probably get a bit more downwards trend potentially. And so I do think that, you're probably going to see uninsured mortgages in Canada back under 5% in the spring market. And so we really have to ask ourselves, what is that going to do? What is that going to do for the market? We've gone from basically 6.3 this fall to, this spring we'll probably be back under 5%. Again, outside the spring market, I don't know where yields are going to be in the summer, but I think that is going to unstick and unglue the housing market, right? You've gone from a pretty frozen housing market to, there's still people that want to buy. They're sort of sitting on the sidelines waiting. And I think if you get those rates back under 5, you'll get things moving. And it's not to say that you have this bull market that just suddenly takes off and you get double-digit price growth. I actually don't think that at all. But I do think it gets the market unstuck. I think you get better volumes. You're probably still getting below trend volumes, but I think overall a better housing market that's actually able to transact. And people are just going to have to really adjust to what I believe is quite probably a new normal of mortgage rates not going back into the 2s. Maybe it's a high 3, low 4, mid 4, high 4 kind of market and how things adjust. I mean, it's interesting if you look at, we had the Canadian national housing data out this week as well. National house prices down 1.1% month over month. So again, still some softening in housing that's coming predominantly out of the GTA and a little bit here in Vancouver. But if you look at the home price index, it's still higher than it was this time last year. So despite mortgage rates technically being higher today than they were this time last year, prices are still higher. So it's showing you that prices are incredibly sticky. We're seeing right now people are pulling listings off the market. They're not getting the prices they want. They're going to retest the market when, again, rates are going to be under 5%. And so, I think it just goes to show you that sentiment is also what drives a lot of housing. I mean, I know like this is a pretty analytical channel. A lot of our viewers are analytical. They're running numbers in the spreadsheet, house price to income charts, et cetera, et cetera. But like housing is predominantly sentiment based. I can tell you that because I work in it, dealing with buyers and sellers on a daily basis. Like people often don't make rational decisions. They make emotional decisions, particularly when it comes to their home. And so I find housing to be very sentiment based. You have to really get out there. You have to feel it to get an understanding for how the market is going to react. And so, the reason why I say prices are higher today than they were a year ago is because a year ago the sentiment was so bad. I just remember the sentiment being so bad, which was, rates at the time were going up 100 basis points at a time. Everyone was like, oh my gosh, they've gone from 0 to 2 to 4. What are they going to stop at? Are they going to stop at 5? Are they going to stop at 6? Are they stop at 7? Are we going back to double digit? Like, people had no idea. People were just freaking out, saying, I can't do anything. They were just shocked. And so the market literally completely froze, and you were able to negotiate pretty good prices last fall. And so, like I said, sentiment plays a huge part in it. So that's kind of something I'll be watching moving forward. Playing on my general thesis right now is I think there's going to be an opportune time to lock in a fixed rate, probably late spring, early summer. Again, this is just me like pontificating. I could very well be wrong. Certainly was wrong on the variable rate mortgage stuff, but I do worry that given where government spending is, given the geopolitical outlook, given the debt loads in general in global markets, I do worry that inflation kind of has to continue to run hot and probably will run higher than we're used to over the coming years. And so I think that, locking in and having more security and peace of mind in that kind of environment makes sense. It makes sense. And so, but coming back full circle, like I said, I see mortgage rates coming sub 5 this spring. I know everyone in the real estate industry is super hyped, and that's the new messaging of, hey, you got to get in. The one thing I'd sort of put an asterisk next to that is looking at the changes that the BC government has introduced, right? And the federal government and all levels of government are now finally coming together, and I think actually making meaningful changes in housing that I think is going to put a lid on prices over the foreseeable future, over the next couple of years, and potentially even longer, which is the days of having this crazy double-digit price growth are gone, in my opinion, which is like, you think about all the density that the government has basically unleashed, right? They've basically removed zoning, and the fact that you can build, 3-plex, 4-plex, 6-plex on most single-family lots, around transit density-oriented stations. You can get 10-story, 20-story condos, and it's already zoned for that. What it actually does is it removes, like places like Vancouver, it actually removes some of the land scarcity. How you made money in development in Vancouver was, and I can tell you, I see it. I talk to these people every day, which is, people have made money, and so particularly a lot of the foreign money that's come in, right? It's not. I wouldn't say they're not really developers. They're like land bankers. And so what they've done, right? Like the play has been, you buy land in an inner city, major metro, right? City of Vancouver, and you sit on it. You don't need to develop it. You pay a pretty penny. You pay a premium for it. You sit on it every year. The price, the value goes up 10%, 10%, 10%, 10%. You just refinance every year, and you just reacquire new land, and it's 10% a year, and eventually you convince enough politicians at City Hall to go through a 3 to 4 year rezoning process. Eventually, you turn those single family lots into a 10-story building, and that's how you accrue your value, and then basically sell off that land to an actual developer, or you finally eventually maybe just develop it. And so you've made the money on the scarcity of the spot zoning and the ability to sit there and hold and wait for the land values to go up. But what this change has done is it's just opened up the supply spigots of land. So as a developer, there's lots of land now that can suddenly be developed. So you have a lot more options. So I actually think it puts pressure in the near term on land values. And so as a developer now, to make money, it's actually going to be on your ability to execute on the construction and on the development. It's going to be on the ability to take what is a piece of dirt and build it into a 12-story condo building and manage your costs and actually build things. That's where the rub, I think, is going to be. And so this is actually a pretty big change, right? And so long story short, I just think the housing market here in Vancouver and large parts of Canada are going through these changes. We're finally seeing governments come out with all these large changes, right? Zoning changes, eliminating single family, removing GST on rentals, CMHC construction financing up to 95% of costs to build and develop for purpose-built rental. I mean, that demand for that product is huge, and it's getting a lot of uptake. And so I do think the supply is coming. While it is facing near-term economic headwinds, I do think that over a 10-year period, when you say, what is the projected increase in home prices, I think it's much more muted. And so I think this is kind of all important to take in this week's video. So again, lots of big changes this week. A lot of moving pieces. We're now into the dog days of winter. The housing market's going to shut off in the next 3 or 4 weeks. So you can pretty much turn the screen back on in February, and we'll start to get a feel of how the spring market is beginning to shape up, and that's going to be incredibly important for the year ahead. So as always, hope to help. I'll see you next week.